Reasonable salary is the single phrase that determines whether your S-Corp election holds up under IRS scrutiny or gets reclassified into a tax bill with penalties attached. The S-Corp owner has two pay streams, and the split between them is where every dollar of savings lives. The IRS knows this. The tax court has litigated it. The methodology for arriving at the salary number is 3 factors deep and uses a public dataset most coaches have never opened. Your CPA owns the number. You do the prep work that lets them defend it. This video walks the methodology, names the precedent case, and tells you exactly what to bring to your next CPA meeting. The S-Corp bargain works in one direction and only in one direction. Salary on W-2 carries payroll taxes, the full 15.3% FICA stack, split between employee withholding and employer match, both of which the company you wholly own is paying. The distribution carries no payroll tax at all. That gap on the distribution dollars is the entire savings case for electing S-Corp. The election was never about income tax. Income tax is identical either way. It's about which dollars escape the payroll tax layer. And because the savings come from labeling more dollars as distribution and fewer as salary, the IRS has standing to ask whether you labeled them honestly. Watson versus Commissioner 2010. A CPA elected S-Corp and paid himself $24,000 in salary on $203,000 in distributions. The math was obvious to him as a tax practitioner. A small salary number, almost everything pushed through distribution, almost no payroll tax owed. The tax court was unimpressed. They reclassified $175,000 of the distribution as wages. Full payroll tax on the reclassified amount, plus underpayment penalties, plus interest from the year the distribution was originally paid. The case is load-bearing in this conversation because it established that the IRS will litigate the split when the salary number is clearly set to dodge payroll tax rather than to compensate the work. The tax courts evaluate reasonable salary on 3 factors, and you need to know all 3 before you set the number. 1. Comparables. What would you pay an employee to do the owner's job? If you'd pay a coach $80,000 to deliver the work you deliver, paying yourself $30,000 is hard to defend. 2. Bureau of Labor Statistics. Occupational employment statistics for your specific role and your specific metro area. Public data, defensible source. 3. Time allocation across the roles you actually perform. A coach who also runs sales, content, and operations does multiple jobs, and the salary number should reflect the weighted mix. All 3 factors documented. All 3 reviewed annually. The Bureau of Labor Statistics is the defensible source because it's public, government published, and the IRS uses it themselves. The dataset is called Occupational Employment Statistics, abbreviated OES. It publishes median and percentile wages by occupation code and by metro area, refreshed annually. Coaches don't have their own occupation code. Most coaches map to management analysts. Some map to coaches and scouts depending on the niche. Some end up as a composite of 2 codes if the work straddles. Pull the BLS table for your code and your metro, print it, and put it in the file with the date you pulled it. That printout is the audit defense if the question ever comes. The IRS Audit Technique Guide names specific patterns that concentrate audit risk, and you should know which side of those patterns you're on. Distributions large relative to salary is the headline trigger. The bigger the gap, the louder the question. Salary below $30,000 in a profitable service business is the second named trigger, because it's the floor below which the IRS argues no reasonable comparable would land. 10-to-1 distribution to salary ratios or worse are the third, and that's the Watson case territory. Most coaches running a clean S-Corp aren't anywhere near these triggers, but the patterns are public and the audit team sort by them. Knowing where you sit is part of the documentation work. Documentation built at setup costs nothing. Documentation built under audit costs a lot. The file you want sitting in a folder ready to hand over if it's ever asked for is three things. The BLS printout for your occupation and metro with the date you pulled it written on it. The comparable job postings you considered when calibrating the number, screenshotted and saved with the date. And a one-paragraph memo from your CPA confirming the salary number for the year, with the reasoning. 3 artifacts refreshed annually when the BLS data updates. Most coaches who do this have never been asked for it. Some have, and the file decides the outcome of the conversation. Jordan is a composite of half a dozen new S-Corp coaches who walked the wrong path here. Year 2 of her practice, $95,000 net income. She reads a blog post about the 60-40 rule and sets her salary at $57,000. No BLS pool, no comparables researched, no CPA memo on file. 3 years later, her income has grown to $140,000, and the salary is still $57,000 because nobody refreshed the analysis. The auditor sees the flat salary line against the growing distribution line, files an information document request, and asks for the file. She doesn't have one to send. The conversation is now expensive, and it could have been free if she'd done the work at setup. The CPA owns the salary number. You own the prep work. That sequencing is non-negotiable. You pull the BLS data, document the comparables, sketch the time allocation across your roles. You bring the package to the CPA who prepares your 1120S return. The CPA reviews, confirms, or modifies based on the role mix and the year's facts, and writes the memo for the file. This is the Find Your Pros callback from Module 3.3 with real execution weight. The CPA is the one who signs off because they're the one who signs the return. Setting the salary yourself and informing the CPA after the fact reverses the order and reverses the protection. Before the next video, pull the BLS data on your own role so the prep work is started before your next CP meeting. Open the Reasonable Salary Research worksheet. Search the Bureau of Labor Statistics OES tables for your occupation code. Management Analysts is the most common starting point for coaches. Filter to your metro area. Write down the median wage, the 75th percentile, and which one your experience level maps to. The number you write down anchors the conversation with your CPA. They confirm or modify the final salary. The same printout becomes the first document in the file that protects the election.